Hey everyone, welcome to today's video, Easy Funding Your Multifamily. So let's jump right in. So in today's video, we're going to cover what exactly is a multifamily, who writes these loans, how to qualify, some great pro tips, and how you can get started right away. So let's go into what exactly is a multifamily. And remember, when we talk about what exactly something is, we're always talking about it from the lender's perspective. And so the way a lender designates a multifamily is it has to be 5 units or more on the same parcel ID, and it has to be used strictly for residential use. This can be an apartment complex, it can be in a group of individual housing buildings. And again, it's generally a 12-month lease. So it's not a short-term rental property. That's a whole different designation. When it's considered a multifamily, it's actually a commercial loan. So the loan process is completely different than a residential loan would be. What we're not going to talk about today, and these multifamily in general is a massive subject. These videos are really intended to be for a beginner, somebody that's looking to get into multifamily just to get a better understanding of what's possible from a lending perspective. We talk a lot about getting an understanding of what you can borrow ahead of time before you even really figure out what you're gonna do, what your property is gonna look like. You should understand what the money piece is out there for you. So that's what these videos are for. So we're not going to talk about mixed use apartments with a commercial component. Um, and those, if you've noticed around your town or your city, you'll see those big buildings. They're typically 5 or 6 story buildings, and those top levels above the ground level are generally apartments. But at the ground level, there's a commercial or a retail component. That's called a mixed use building, and we're not going to talk about those today. We're also not going to talk about ground up for multifamily, a whole other topic. Definitely could probably do 5 videos alone just on ground up. So we're not talking about that today. We're not going to talk about something called value add, where you can purchase a building that needs rehab. A lot of our clients actually do value add acquisitions and loans for multifamily, but that's something I just don't have time to get into today. Again, for another video. We're not going to talk about blanket or portfolio loans, which are essentially just one loan that go over multiple properties or multiple parcel IDs. And again, I'll do another video at some point about that particular element. So we're really just going to be talking about apartment loans or multi-unit loans, anything 5 units and up. That's what we're talking about today. So who makes these loans? Well, as you might imagine, the usual suspects, the local, the regional, and the national banks. Um, where we like to go is for anything where the loan amount is a million or more. We will typically go to agency, or we've done some life insurance company loans along the way as well. I'm primarily going to key in on an agency because that is where we do most of our work for our clients, is in the agency realm. And when I say agency, I'm sure I'm going to talk about it, but it's Fanie or Freddie. So it's a Fannie Mae loan or a Freddie Mac loan. Under a million, which we do see a fair amount of deals that require a loan under a million, there we're going to go into something called small balance commercial, and that's a whole different bucket completely. As I mentioned, we're really going to only focus on these two. We've done hundreds and hundreds of loans here in the multifamily realm, and I believe they've all been done in either agency or in small balance commercial. So, again, a smattering of other types and other products, but most of them come in these two buckets. So that's what we're going to talk about. Let's first talk about what your options might be if you choose to go to a local or regional or a national bank. The pros are that many of these banks do like multifamily. One of the things that may help you if you're going to go to a bank is if the bank sees that there's a benefit to the community. And we do see this from time to time. It's potentially easier to qualify than it might be if you're going to an agency lender or to a small balance commercial lender. One of the cons, though, is that many of these depository institutions, as I'm recording this, are going through some turmoil. There's a lot of struggle right now in this realm. So we've done some surveys here. We're based in Charlotte, and I've talked to people nationally as well. Many banks, and when we talk about banks in this regard, we're talking about a bank that takes in deposits. They're struggling, and a lot of them are not lending on anything. They may love multifamily, but they're just simply not lending because their ratios are out of whack, or whatever. They've got a lot of loans going upside down, or who knows what. So that is a big con right now for the banks in general. Um, when they were, I guess, in their heyday, or if you can find a bank that will lend or that is lending, you are going to find typically lower loan to values than you will with some of the other products we're about to talk about. Um, they also come with shorter amortization schedules, and when they do that, I won't get into all of the semantics of that, but essentially that leads to a lower reduced cash flow for the building itself because the loan is being paid off faster, therefore the payment is higher, and when the payment's higher, there's less money coming back to the owner of the building. Um, Another big drawback, I think, by the banks is that they often require a personal guarantee, whereas the products we're going to talk about are, in fact, non-recourse for the most part, and so they don't require that personal guarantee. Most investors really don't like the personal guarantee aspect because it means if that asset doesn't perform, the thing goes into default, the bank has the right to come and go after that individual or those individuals that own it personally. They can take their house or whatever assets they may have, and in many cases, they're required to pledge those assets as part of the loan. Um, and a lot of these banks as well, again, I mentioned they're depository institutions. One of their methods is, and the reason that a lot of them actually make loans in the first place is they want to get this investor's depository or a business account moved over to that specific bank. They want the depository relationship because they're able to take that money then and invest it or invest it or make loans against it. It raises their ratio. It enables the bank to actually make more money. So the name of a bank tip or the name of the game for a bank typically is that they want to make a loan, but then they'll require that individual or that group of individuals or that business to move its depository accounts to that bank. The other products we're going to talk about, again, they don't have that requirement, which a lot of people like as well. So let's go into under $1 million. So anything where it might be a smaller property, maybe it's an eightplex or what have you, it's going to require a smaller loan amount than $1 million. Because the minimum for agency is $1 million. It used to be a little bit less, but right now it's hard to get them done for anything under $1 million. So if the loan amount is under $1 million and we can't get it at a bank, then we're going to be looking at a small balance commercial lender. And again, for anything over $1 million, it's agency or life company. So let's talk about the under $1 million. There are multiple national small balance commercial lenders that specialize in these loans. Some of the pros. So think of it like this way. It's really across the board, and there are a lot of these small balance commercial lenders that are out there, and a lot of people don't even know who they are or that they even exist because they don't have branches. Unless you know who they are, you won't know who they are. They're not obvious to the general public, but they're out there, and many of them are huge, and they're making loans, hand over fist right now. Again, in this environment where the depository banks are struggling, many of these small balance commercial lenders are heavily liquid. I'm in touch personally with many of them. I'm on their email list, and they're tapping me on the shoulder pretty continuously, saying, "Hey, bring us deals. We've got money to lend." So they're definitely out there, and they're definitely lending right now. Some of the pros: you can get a 30-year amort on a lot of the loans that they offer. This will lead to better cash flow typically. They do have non-recourse options for the right loans. Not all are non-recourse. Some are, they require, a personal guarantee. That requires a bit of shopping if that's something that you're interested in. Some of them still go up to 80% loan to value, which is great. They're underwritten on a debt service coverage ratio. So basically, what they're doing is they look at the asset only for the income. So the income from the property must support the expenses of the property and the loan. So we'll probably do another video just on debt service ratio and how that's calculated. But just know that these loans they're not requiring, and they don't really, it doesn't really matter if you're an individual that has, let's say, a wonderful job, a great corporate job, making lots of money, and you want to buy an asset that's not really performing that well. Your income, unfortunately, won't help you in that regard. They're going to look specifically to make sure that that asset, that multifamily property, will generate enough income, again, to pay the expenses of the property and also the loan that's being issued. And in many cases, these small balance commercial lenders will lend to foreign nationals. Another pretty interesting fact that a lot of people don't know. Um, some of the cons, or one of the cons, I think the only con I could come up with is that rates can be higher than bank rates in the smaller bucket, and I think that has more to do with the smaller loans. We used to say that the small loans require as much brain damage as the larger loans, and I think that it's just there's not as much profit in a smaller loan, so the rate is imputed. It's a way to incentivize these lenders to actually make the loan because there is a lot of cost that goes into them to the lender as well. That's my own opinion. I don't know that for 100% fact. So let's talk about over a million. Again, I mentioned agency life insurance. There's also another thing called FHA. For the purposes of today's video, we're only going to key up on agency. So the pros with agency are, again, you get a long amort. That leads to better cash flow than what you'd find at a bank. Typically with agency, what I find is, when we go shopping, we're typically looking at the best rates on the market. Um, I'll say that that's not always the case, but it's very typical that you're going to find the best rates in the agency. I guess my comment here would be, if you're somebody that's looking to buy a multifamily property, or you're looking to take maybe an exit on a property that you purchased and rehabbed, then always, if it's over $1 million, always try to look at an agency loan. It's considered the holy grail. I'm going to tell you some more reasons why here. We do have interest only options with these. It's non-recourse, as I just mentioned. You can still get up to 80% loan to value in many cases. It's also an assumable loan. This is something you don't find in the banks. I don't think you find it in the small balance commercial. This is also assumable. So if you ever do go to sell and we're in a different interest rate environment, it might make sense for that buyer to assume the loan. And it's it's a fairly involved process, I understand, but it's something that's there. A lot of investors really like that ability to have their loan assumed. And again, these are also underwritten on a debt service coverage ratio. So they're looking at the specifics of the building, the expenses, the loan amount, the loan payment, and they're going to come up with how much of a loan you can actually get so that the building will still pay for the loan and you'll receive some cash flow afterwards. It's a great way. And what I like about that actually is it self-polices so that you can't actually get a loan on a property that won't perform because of the way it's underwritten, if that makes sense. So it keeps people from getting into real trouble. Now, it's not to say that the thing you could run it into the ground after you get one of these loans, and then it wouldn't perform. But there's also measures in place as well by the lenders to help ensure that that doesn't happen. Some of the cons here are you've got to have some experience. So you can't come out of the gate, go find a great property, and we get calls like this from time to time where somebody has gone to a seminar, a weekend seminar, found been told by the guy at the front of the room that you can get you can enter multifamily, become an investor, become a bazillionaire overnight, and just go find a great property and then go get a lender. Well, uh, I wish it was that easy, but unfortunately, it's not. So I've had to break some bad news to a fair amount of folks who've called in over time. And one of the first things that we ask when they call us is, "What's your experience?" So you've got to know that going in if you're going to look for one of these loans. They also have a high net worth requirement, and typically that requirement is you have to have a net worth, or it's a combined net worth if there are partners, but it's got to be combined to be at or greater than the loan amount that you're requesting. Um, so that's something else to keep in mind. If you have no assets, and no experience, you're truly not gonna be a candidate for an agency loan. Liquidity, they also have a pretty steep liquidity requirement. And last loan I did was they were looking for 12 months of payments, and that's post closing. So they want to see that you have the wherewithal in your bank account essentially to make 12 months of payments if the property didn't do a thing. If you weren't making any money at all, you still have to show that you can carry that payment for at least 12 months. So that's another kind of thing that you got to consider going in. We talk about all this up front with our clients to make sure that we're covered in all these areas. There are some seasoning requirements also with agency. And the main seasoning one. There are some other ones that have to do with cash out and things like that, but the main one that you have to be aware of is these are specifically only done for stable properties. And by stable, the definition for the agencies for a stable property is it has to be at 90% um, occupancy for 90 days in a row for the last 90 days. So if you can show that, and one thing there is when they say 90% occupancy, they mean economic occupancy. So you have to be collecting 90%. You can't just have 90%, filled up, but a quarter of them aren't paying rent. That won't qualify for that seasoning requirement. So that's again, it keeps really only the best properties in as candidates for an agency loan. And this one's a pretty big con, I would say, with the agencies, is their insurance requirements. In my experience, they have kind of continued to change, and the way they don't really bend. You can get waivers and exceptions in some cases, but the insurance requirements are fairly steep with these agency deals, especially if you're near the coast. I actually had a deal where the insurance went up because of the requirement of the agency, and I think it was a Fannie Mae loan at the time. They were requiring this new insurance be put on the property, and it made their premium go from like 35,000 a year up to 86,000, I want to say. And it made the deal too expensive for the person to go forward. And essentially, it also made the deal not underwrite because now we had to add all that new insurance to the expense line. And I mentioned we do these on a debt service ratio configuration, and when you plugged all of that in, the amount of loan that they could now get or could qualify for dropped significantly. I think we had about $1 million drop in proceeds based on plugging those new expenses in. And again, it just made the deal turn sideways completely. And we're still at a standstill on that particular loan, trying to figure out what we're going to do. So small balance. How do you qualify? And again, this is going to be very, very general. It's tough for me to get real specific when it comes to the small balance bucket because, like I mentioned, there are multiple lenders. They all have their own set of guidelines. They they change their appetites fairly frequently. So it's really a full-time job just staying up with what a small balance lender will do. That's what we do here at Capital Connection is we stay in touch with them on a regular basis, and we're constantly building our relationships, and we're constantly getting a better understanding of where they are, where their appetites are, what they'll do, what they won't do. So this is a little tough to give you specifics, but I'm just going to tell you kind of generally. Um, for under a million, you need 5 units or more, right? So it's got to be a true multifamily. They also typically do want a stable property and 90% occupancy, but that's not a hard and fast rule necessarily. So if it's less than 90, it still has a potential to go small balance. Typically, there's a minimum loan amount of 100,000. I've seen them lower than that in the past, but right now in today's climate, I think you'd be lucky to find a minimum loan, so a loan amount of 100,000. But I wouldn't say it's not possible. For the purposes can be for a purchase, a refi, or a cash out. So they'll do any of those three. Again, this is just a sort of a rule of thumb, minimum FICO. They are going to look at the FICO, and I don't think I mentioned it with agency either. But with agency, they do look at the FICO of the borrowers or the sponsors. Um, but it seems like it's still fairly gray as to what they'll take and what they won't take. It's more or less they look at the whole deal. So if you had, let's say, a FICO of 600, and you were the main guarantor or the main sponsor, not the guarantor, but the sponsor, but the rest of the deal was very, very strong. If it was a cash flowing property, it was, been stable for a long, long time. You're looking for 70% loan to value or something, then that credit score will probably be granted. Like, it won't disqualify you, maybe even lower. If so, in other words, it really does have to do with the whole story. And that's kind of what I really like about this whole business, actually, is that you get to really kind of understand every story is different. So there isn't it's in some ways this is more like art than science, if you will. So keep that in mind as you're learning these guidelines. They're really just meant for you to kind of get a rough idea. Um, this one is though probably a little more standard than the rest of them. Debt service coverage ratio minimum is 1.25. And again, we'll go into explanations on that, I think, in another video. And max loan to value, I still see them getting up to 80% even in today's climate. And I have in there cap rate estimate. Um, Again, I don't really want to get into that right here, but there is a way that you can, if you know the NOI, the net operating income of a property, and you know the cap rate of that market, and the cap rate stands for capitalization rate. It's simply just a number that appraisers use in order to sort of comp properties to properties. And if you happen to know that number, there's a way to calculate that. So I say all that to say that you can, if you're shopping for a property and you call a lender, if you know the NOI, know the cap rate. In fact, you can figure this out on your own. You essentially divide one into the other, and it'll come up with an actual value. And that value, we've done that many, many, many times, and I will tell you that it's not 100% accurate, but it's darn close. So you can really kind of get an idea of what a property's worth just by using that little methodology. So again, we'll probably get into a better explanation of that at some point in the future. Liquidity, 6 months of payments post closing. Again, just sort of a rule of thumb. I've seen it lower, I've seen it higher. So just be aware that that is something that typically they're going to ask for. They are going to want to see that you do have some money in the bank once you've closed. So that doesn't include what you need for a down payment or anything like that. All right, so how do you qualify on an agency loan? Again, five units or more. I mentioned this, the stable thing there. You've got to be 90 for 90. Um, Here's another seasoning one that I sort of mentioned. For cash out, you must have owned the property for 12 months or more. Or if you don't and you go for a loan, they're going to do it based on the cost. So they're going to look at how much you bought the property for, and then how much, if you put in rehab, how much those dollars were, and then they're going to give you a percentage of whatever that was. Um, so if you're going for cash out and you want to use a new value, you have to have owned it for 12 months or more. Loan to value, like I mentioned, is up to 80%. Not going to get into the cap rate thing. Minimum credit there, they say 620. Again, I think that's pretty malleable. So just know that that's a question that's going to get asked. If and I have seen this too, where you have three partners, and let's say one of the partners has really poor credit. I've seen it where they've just basically reduced that partner's ownership. Sometimes they'll put them down below 20%, and that solves that equation, because if you're under 20%, then you actually don't have to be underwritten as part of the loan. So you can still be on the entity, but just know that that's there, that there are ways, not around this, but there are ways that you can mitigate the damage. Let's say if there's somebody in your group, or um, somebody has really kind of poor credit. Always work on your credit though. Little pointer. Always be working on your credit, because no matter what you're going to do in real estate investing, or borrowing in general, credit is always a factor. I would say it's less of a factor maybe than it used to be in commercial lending, but it is definitely a factor, and it is a question that I think we get asked every single time. So my advice is, like I said, work on your credit. There's companies out there that can help you with your credit score. They can keep working on it for you, and building that credit score up. You should really um, take heed on that one. I mentioned this before, you need 2 years of multifamily ownership to qualify, and then 12 months of payments liquid post closing. I think I mentioned that one as well. And these are underwritten to a debt service ratio, typically of 1.25. Again, sometimes that number changes a little bit, but that's pretty much the standard. All right, so we're up to secret pro tips for under $1 million. Now, again, this is my best advice. If you think you're going to buy a property, or you want to refi, and you know that loan amount's probably going to be less than $1 million, your best bet is to talk to a small balance commercial lender. Talk to somebody like us, where we have relationships with multiple small balance commercial lenders, and really get the lay of the land at the time that you're looking to borrow the money. So many factors will go into what your options might look like, that you need to talk to somebody that knows about this stuff before you get too far down the line. And I say this because of so much experience with people that have gone all the way down the line, and then they think, okay, now I need to go get the money, and they think it's going to be easy. And they don't realize that maybe they're looking at a property. Here's an example. Maybe they're looking at a property in an area that doesn't have the right population for a lot of the small balance commercial lenders. And that's actually a real thing. So in fact, I had one just yesterday that we had an inquiry, and the loan amount is probably about, I think it's about 900,000. So I called a couple of our small balance lenders, the ones that came off the top of my head, and they don't lend in that area. Fortunately, we were able to find one that does, but it's tough for people to figure that out at the very end. So you just don't want to get surprised. So yeah, look at that stuff up front. Consider 0% lines of credit. This is also another tip that I think we're putting in most of our videos here. But the reason I bring this up almost every time is because I've seen a bunch of our clients do this. I've actually done this myself personally several years ago. And it's just a great idea for investors, and there's so many different uses that they can do. So basically what that means is there's a program out there or a company that essentially has this figured out, that they can take an individual with the right credit profile, and they'll help you with the credit profile if you don't have it. But their kind of shtick is they can get an individual up to $250,000 of 0% lines of credit. And if you have a married couple or two partners, let's say, you can combine that. So it can be up to 500,000. Now I'm not claiming that as the reality. I'm just saying that this is what this company says. We have an affiliation with them, full disclosure. We do receive a little bit if you go and work with them. But I will say should be a link at the bottom of this video. If you're interested, use our link if you would. You'll get a discount, a pretty substantial discount, if you go through us rather than going through their front door. And again, check them out. It's a great way. So if you have that money, a lot of times, under $1 million, let's say you need to put 20% down. Well, that's 200,000. You could go a long ways towards putting your down payment down with 0%, and that's your rate, and not come out of pocket. So just a great little tip I wanted to include. Now for over $1 million, and this is for kind of the first timers. As I mentioned, if you're a first timer, you're not going to qualify on your own. So what I'm telling you here is you got to go network. And this is what I hear from a lot of our investors, really how they got started and what they do. They network with other real estate investors. They learn how to analyze a property. Lenders are a great resource at doing that as well. Build relationships with brokers so that you're looking, you're maybe getting deals in. And if you have networked properly, one of the things you can bring to the party when you're new is finding a great property at least. And I've seen that happen where somebody just, they didn't have any experience, they didn't have a whole lot of money, but they had a big desire, and they went out and they found a property and brought it to some people that did have some experience and some money and some net worth and things like that, and they were able to partner up and get a little sliver. And I think I'll mention that here. But if you can get a property and understand the financing potential, so that's the other part of it. If you also know, hey, look, this is how we can get this thing done. I've already figured out there's money available to get it done at this level and these things. I would say, and this is what I try to teach my kids this actually, and I've learned this along the way just by talking to a lot of investors. I think the best thing you can do, again, if you're a first timer, is to get one under your belt, and then go from there. Because if you're probably going to have to give up a lot in the beginning, but if you can just get your name on a deal, then it begins to give you the experience, and you can point a future lender to that experience that you have. So keep in mind, again, it's generally a team sport. The more you bring to the party, the higher split you can generally negotiate. I have one of my clients now who I've worked with him since the beginning. We've done all multifamily. I've talked about him before, but he and his dad invested in multifamily. I think we did maybe 12 or 13 loans for them over the course of 5 or 6 years. And what I see him doing now is he's simply, because of his net worth, his experience, he's got, I don't know, I want to say 350 units under his belt now, under management. They just sold a big property, but he is available to come on as a sponsor. So he'll essentially come on as a sponsor. He might take half the deal, and he doesn't really do a lot. Now he's going to want to do some if you don't have any experience. But my point is that he's in a position now where his resume or his experience is very attractive to be added to a loan application, and somebody that he's actually kind of sought after at this point. But it wasn't always that way. I'll tell you this real quick. His first deal that we did for him, he actually went to, this is his story, is he went to 60 banks before he came to us, and somebody referred him to us. And I don't know if it was necessarily 60, but the point is he had a hard time getting this one deal that he had found. And he was one of those that when he was brand new, he didn't really realize how hard the money might be to get. And he worked hard to find this deal and really dug in to try to figure out how to do it. He found us, and actually we were able to get him a lender within 2 or 3 days of when he contacted us initially, and we closed like 3 weeks later for him. So he's been kind of a lifelong client ever since then. But anyway, and this also, I would say, for if you're more experienced, it's generally the same. And then you might also want to consider a syndication. Not going to get into all of the things with a syndication, but that's an option. That's basically where you bring in passive investors. It requires the SEC, it's a lot of documentation, but that is a fairly common thing we see with larger deals. And the more experienced investors, that's what they're looking to do. All right, so how do you get started? Well, remember, always find out what your best funding options are as early in the process as possible. I cannot stress that enough. I think I beat that one into the ground. I recommend trying your bank first. I think that's your best. It's your best bet to start off with. So whoever you bank with, or somebody locally, if you have, if you're looking at a property, you're looking at a deal, take it to the bank and talk to them and see what they say. And I think you'll at least start to get a feel for maybe where the market is on your specific deal. And then I would say if you run into any issues, and unfortunately, I think that you may in today's climate, just because of what we know about how many banks are actually not lending right now. Give us a call or somebody like us. We'd love to earn your trust, and you can click on the link below, send some basic information, and we don't charge anything for this. We'll give you an evaluation and see if there's anything out there that we might be able to help you with, and love to help you get started. I hope this has been helpful, and I want to say thank you. This channel is kind of new for us, so if you will please subscribe, really helps us. We're trying to build this. I wanted to make this simply a free place for people to go to get educated, to get an understanding, because I think this is a pretty underserved market space, if you will. Don't see a lot of people talking about this side of real estate investing, and I think my belief is that this is the most important side. There's plenty of webinars and YouTube channels and people you can see that will tell you how to find a property and how to analyze it and how to manage it and all those things. But remember, you can't do any of those things if you can't get the money. So I really think that this will help you at least understand what the landscape looks like, if nothing else. And by the way, if there's anything else you want us to talk about, let me know. Respond. I'm open, obviously, because this is a new channel. So whatever you want to see, we'll take it under consideration, and we'll likely try to make something happen as far as some education on it. So thank you very much. I appreciate you joining me, and we'll see you on the next one.